4.5 years since its last rate cut, about 14 months since the last rate hike. Bloomberg's coverage of the Fed decision continues right now, live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Boston.
And I'm Alex Steele. And if I told you we had a jumbo rate cut and stocks may close flat and the bond market was selling off, you would not have believed me.
I kind of would have actually believed you.
Okay.
Oh, no, I wouldn't have.
You wouldn't believe me. Thank you very much. Even the Russell, which you think the small caps are going to be the stock index, it's going to do really well on this kind of jumbo rate cut, or even mid caps, they can't hold on to this as well. The Russell 2000 is just up by 0.1%. And I feel like, Romaine, if you take a look at the dollar and the 2-year, that does not encapsulate the drama that has unfolded over the last couple hours in terms of the market action.
And a big part of that drama was just the outsized nature of this cut, and Jay Powell trying to thread that needle, giving the market some sort of reassurance that this was about, I think in his words, supporting a strong labor market, but not necessarily saving us from a weak economy. I don't think everyone's buying it.
No, slow your roll, but
Yeah.
we have zero tolerance for low employment, for higher employment. I feel like that's the combo.
And of course, we came into this day not knowing if we were going to get that jumbo rate cut, as Alex was just talking about. Most economists out there were predicting 25 basis points, but Jay Powell went with 50. Here he is weighing in on today's decision.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the S&P. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate.
We're going to get some great insights on the big program today from a lot of folks, including former Fed Governor Betsy Duke, economist extraordinaire Claudia Sahm, and a conversation a little bit later here with the SEC Chair Gary Gensler. But let's start with the headliner. Ken Shinoda, portfolio manager over at Doubleline Capital, flying all the way in from California just to see us here in New York. Ken, great to have you here.
Thanks for having me.
Were you surprised?
Not really surprised. I think that they were so behind the curve, hiking rates when inflation had picked up, that they wanted to tell the market that we're not afraid to cut, and so I think they did the right thing by cutting 50 basis points. It was kind of priced into markets this morning, and I think why equities have pulled back a little bit is while they cut 50, they're still data dependent, and they didn't get too dovish in his remarks.
Mm-hmm. Well, I'm curious about that, too, because when we talk about what the market expectations are, I mean, they gave some projections in that dot plot that seem to suggest they're going to be relatively aggressive with additional rate cuts going forward here. And I'm wondering why the market didn't find some solace in that.
Yeah, they're projecting another, call it 50 basis points to the end of the year. So we'll get another 25 the next two meetings, and then 100 over the next through 2025. And I think maybe the market wanted to hear some more dovish language on we're going to get back to neutral quicker. Mm-hmm. They also moved the neutral rate up a little higher. Their estimation of the neutral rate moved up a little bit. So maybe that has something to do with it, too.
Like 3.4%, right?
Yeah, but it was interesting, though. I mean, 10 officials still see 100 basis point cuts or more. 9 see 75 or less. So it's still really wide for this year. So what do you do in the market? Like, is this a good time for corporate credit? Like, do you just sit tight on where you are in the curve?
Well, I think a lot of people have been hesitant to move back into the fixed income markets. They've been sitting in the T-bill and chill, and you got to start coming out the curve. I know the rates have rallied, and the last couple times we've been on, you've said, what do you recommend investors do? And I've been saying, you got to come out the curve. Maybe you don't want to go all the way out to the 10-year. Come out to the 2-year. The 2-year was at 5% not so long ago. Now it's down to 3.5%. So you got to start increasing that duration of your portfolio. The timing isn't that great since we're at the lower end of the trading range, but you're never going to time the bottom perfectly, just like you won't in equities. So you got to start legging into more fixed income into your portfolios.
What about the corporate bond market?
The corporate bond market has had a great run from a spread standpoint. It's tightened a lot. It's very high quality, but just from a spread standpoint, it looks a little expensive. But I'd rather be there than in some of the riskier parts of the market. The credit curve has flattened a lot, meaning the yield pickup to go buy something riskier, like CCC high yield, for example, has come down a lot. So you're not getting paid that much more to take more risk. So I do like staying in the higher quality parts of the fixed income market.
Can you sort of elaborate on that as well? Because we're hearing the same thing from folks in the equity space saying, yeah, we're going to stay invested, but we're gravitating to things that are a little bit more safe or defensive or boring, I think is what one of our guests called it earlier this week here. But what does that mean? I mean, in terms of, because if it's not just the shortest of short-term duration in terms of, doing NT bills and other money market type instruments, then where do you find that safety?
Well, high quality can also be out the curve. 10-year Treasury is high quality; it's government guaranteed. You could pick up additional yield by going into
Locking in for 10 years, or taking that with the idea.
I'm just saying you can buy Treasuries to get high quality exposure.
Gotcha.
On top, the next step would be going to things like government guaranteed agency mortgage-backed securities. You get paid some spread to take on prepayment risk, and those look really cheap relative to history. And investment grade corporate bonds are another tool in the toolkit for investors where you can pick up a little bit of spread, but you're not really taking a lot of credit risk. I also don't mind the higher quality parts of, for example, high yield. Double B high yield, there's still pretty good quality companies. If you do your credit selection, you can pick up some additional spread there, and you're not going to the junkiest parts of the market.
When you look at past easing cycles at the start of it and the reaction that you got, let's take agency MBS, for example, mortgage-backed securities. Do you think we're going to see a similar repeat of those moves, or has that market changed so much from the previous easing cycles, or major easing cycles that we saw?
No, I think agency mortgages had been the value trap in fixed income for the better part of 2 years up until the last few months. They had just continuously lagged treasuries and corporate bonds. And really part of the reason was the rates were so high, and a lot of investors need the short-term rates to come down to buy these assets on a levered basis. As the Fed cuts, this is the best environment for those assets. So I think we're going to see continued performance out of that and fixed income broadly. I do think we ran a little too far too fast. We're going to see a little bit of a pullback potentially. You're already seeing it today. Use that as an opportunity to add some more fixed income into your portfolios.
Yep, looking at the 10-year at 3.7 is where we sit right now. Before we let you go, how do you trade the next data point? And what is that now?
Well, per Powell's comments, I think it's a lot of it's on jobs, right? We want to see what's going on with the labor market. To get more aggressive cuts than they're talking about, we need to see a more rapidly cooling labor market in order to get kind of more aggressive views from them.
All right, Ken, great to have you. Got to leave it there. Ken Shinoda, portfolio manager over at Doubleline Capital. Reaction here to the big Fed decision, and reaction, Alex Steele, to the market reaction, which I think, as you alluded to at the start of this program, not what I think a lot of folks expected. At one point, we did have a decent rally going on here, but that has faded in a big way.
It really has. And even in the mid caps, which you could argue should be the best beneficiary of this, at least that's what Bank of America thinks, right? Even there, they're barely up, just up by 0.1%. I do wonder, though, how much of this is going to be position and position shakeout, particularly when some longs were taken off, like in the Treasury market. So once we get a cleaner read, will we get a cleaner read then on how the market will react to the Fed?
The volume really did pick up here in the final few minutes of trade, seeing a spike in the VIX here. And interesting, too, looking at that 210s curve now at the highest level that we've had going back to 2022. A full breakdown of all the market action coming up in a second, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you through the closing bell with a global simulcast that starts right now. Carol Massar joining us in the radio booth alongside David Gura, filling in today for Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, including our partnership here on YouTube. And Carol, you talk about the market reaction to that Fed meeting, the market reaction to Jay Powell. Not quite what we expected.
No. First of all, I was surprised by the 50 basis points. Kind of shocked me. We saw such a significant, or decent, I should say, equity rally right off of that. And then we've seen stocks retrench. So I feel like investors are still trying to figure it out. Does 50 basis points, David, does it mean that there's some troubles ahead? Yeah, and I just was struck by how emphatic Chair Jerry Powell was during the course of that press conference, saying the Fed is not behind the curve here, saying things are different than they were back in July, saying this isn't a sign that they missed the ball back at that last meeting. Very forthright. Also, promoting a lot of clarity, a lot of caution going ahead to this next meeting that, it's not divine, it's not gospel what's going to happen next when they meet again in November.
But I am interested into the reaction function, right? It's very clear that they have zero tolerance for a weaker labor market. So what does that actually mean? So you get 1/10 of a tick up in the unemployment rate. What is that then reaction function? They're expecting 4.4% for U3 in 2024. So how do you then trade something like that?
And particularly, too, when we talk about this idea of that neutral rate coming up, at least their projection for it at 3.4%, definitely higher than what the market had priced in. So maybe you get a bit of a repricing. But as we always have to point out here, the market reactions that you typically get on the day of these Fed meetings can change in a big way in the days that follow. Here on this Wednesday afternoon, Fed Day, The screen looking a lot different than what it looked like just a few minutes ago. All red across the screen with the Dow Jones Industrial Average down roughly about 100 points on the day, or about 0.2%. The S&P 500 down about 16 points or 0.3%, a similar percentage drop for the NASDAQ Composite, as well as the NASDAQ 100. And if you're looking for outperformance, well, there you have it on your screen, and it is minor outperformance. The Russell 2000 fractionally higher here on the day. We'll just call it unchanged. S&P midcaps also similar move, and the Dow Transports a little bit better of a performance, though that's only up 0.4%.
Right, small caps at their highs today, up almost 2.5%. In terms of the S&P 500, though, if you look at it, almost an even split. More than 200 names actually gaining ground here at the close. 286 to the downside. So, Alex, a little bit more of a negative tilt.
Yeah, and you take a look at the IMAP. It is mixed, but I think that what it's mixed by is quite interesting. You have well, actually, it's not that mixed. I was looking at mid caps. You're actually looking at the majority in the red. Utilities, though, not doing as great, and that's so interesting because if you were going to have a 50 basis point cut, you would have thought that utilities would have done really well, but that necessarily isn't the case today, which just shows that we can't really predict how the market's going to react to this. You have tech getting hit as well as financials.
Not a brat, Matt. That's a
No.
Matt, not on this Fed Wednesday. All right, let's get to some of the individual gainers, folks.
You're so hip, Carol.
She was just in L.A. Was it L.A.? Where was she? She was somewhere
I don't know.
cool.
She never tells us where
She was somewhere cool.
She just disappears
There we
in the
go.
high seas for days.
Highly recommend doing a show on the beach.
Yeah.
It's a
Thank
really
you.
good thing.
Thanks for rubbing
We'll
it
work
in.
on that.
Back on that, yeah.
You're all invited next time. All right, let's get to some of the individual gainers. GM finishing off its highs, at its highs up more than 4%, but still a 2.4% gain here at the close. A top gainer in the S&P 500. The company's EV customers can now tap into the Tesla I superchargers starting this month. Remember, they had an agreement last year between Mary Barr and Elon Musk. So some upward sentiment, if you will, for General Motors. Victoria's Secret, check it out, guys, up about 3.5% here. The company was upgraded. The stock was to equal weight from underweight over at Barclays, which said the worst is behind the company. Also raised the price target to $25 a share from $23. So the stock finishing pretty much at $25 a share in today's session. HubSpot, another one, an outperformer, up 2.3%. Call options also tripling today. Our BI team out with a note talking about the company's analyst day, saying the company's position in sales, marketing, and service software continue to strengthen in the small and medium-sized business segment due to AI innovation and more. And they also noted some of the company's product launches. So that's some of the outperformers here today, David.
Looking at those underperformers today, a few caught my eye. Zegna Group, maker of men's suits, men's clothing, Italian company, went public via SPAC back in 2021.
I think Remain Your Suit came from there.
I didn't want to call him out. Perhaps it did.
He has a whole wardrobe here. That's the thing.
Anyway, flagging that profits were lower there at that company in the first half of this year compared to the quarter and a half before
So I
that.
can expect some discounts.
There you
on
maybe
suits going
Now you're
perhaps.
talking my language.
Time to
Check
go
it out.
shopping.
Anyway, kind of emblematic of the fact that luxury is going through some difficult times here. The CEO saying today that it's going through an important normalization phase given macroeconomic and geopolitical uncertainties, and the overall environment is expected to remain even more challenging in the weeks and months ahead. Another company suffering a little bit today is Cisco, food distribution company. The CEO of that company speaking at a Wells Fargo consumer conference in California today, saying that traffic is down at restaurants by as much as 3 or 4% and sees that being a persistent problem going forward here. That company closing lower. And then Trump Media and Technology Group. We are at this pivotal moment. Of course, Donald Trump owns more than half of that company's stock, more than $1.8 billion worth of it. The lockup period by which he can't sell that stock ends tomorrow, provided those shares don't close lower than $12. He says he's not selling. We'll see, but the company continues that kind of downward slide we've seen since March, when this company was trading above $60 a share, far below that today.
So that's sort of the micro look. On a macro level, we go back to the bond market. We're looking at a sell-off all across the curve. You got the 2-year yield up 3 basis points. The 10-year yield is up 7 basis points. That's the most since August 15th. I know it doesn't seem like that long ago, but a lot has happened since then. But what's so interesting, if you look at an intraday chart of what the bond market did, particularly in the 2-year, you get a 50 basis point cut, you got buying right away, and the yield falls. And then as the conversation continues and the presser gets underway, and it seems like the Fed is in no rush, you guys, to do any more 50s. They're in no rush to cut dramatically and drastically, and then you wind up seeing the selling kind of pick up, particularly on the long end.
There's a big question that I have, though, and the question is, when we look at the targets that they have on the dot plot and what Jay Powell said today, how much can you really take that as gospel here? I thought Mike McKee, when he sort of broke the news at 2 p.m., he pointed out a couple of big things. This was the first dissent that you've had on the FOMC since 2022, and the first dissent by a Fed governor since 2005. And he seemed to suggest here that this might be an expansion of that type of dissension going forward over the next few meetings as everyone tries to figure out where we're going.
Which makes you think about the future discussions, right, around the dot plot as new data comes in. I was thinking about tomorrow at 8:30 a.m. Wall Street time, weekly jobless, like these weekly reports, which are much more timely data than the monthly jobs report, David, become even maybe more important.
We just have to keep thinking about the crucible in which this is happening. Of course, we have an election coming up. This was the last meeting before that election. The next Fed meeting takes place a day after people go to the polls here in the U.S. This Fed chairman, emphatic as he has been before, growing increasingly irritated, I think, with this question that the Fed might be susceptible to political influence, saying that wasn't the case here. That's not going to be the case going forward. But we already have a statement from Vice President Harris applauding the Fed for the move that it made today. And then we have Donald Trump, the former president, here in New York tonight at a big rally in Nassau County. He's trying to get folks elected down ballot, House races in Hudson Valley and in Long Island. No doubt this is something he's going to bring up during the course of the speech that he gives tonight. So we'll be listening closely to what he has to say. He's kind of questioned the merits of the Fed's sort of very storied independence in past speeches.
Mention salt, and all of us in the New York metro area,
True.
it definitely catches our attention.
We start to pay attention again. It's 100% true. But if we go back to where we were last Thursday, so that was more of the 25 camp, right? And then you had the Wall Street Journal article come out on Thursday night where Nick Timrose talked about the fact that 50 might be on the table. Then you saw the market re-rate on Friday, and that continued. So in my mind, don't you just like kind of check out and check back in 4 days until the next Fed meeting and see what we're talking about? I mean, that's kind of what happened.
I think that is kind of what happened. It's kind of basically the Fed did meet the market, and the market was happy with that. And like I said, what happens over the next couple of days? But I thought, just to David's point, too, about the political implications, if you will. I know Biden is supposed to speak on this tomorrow. You do wonder how this is going to sort of play into the election cycle as people now start to talk about inflation coming down. Maybe interest rates ends up being a net positive for some people's pocketbooks. I don't know if it's going to come that fast, but that'll surely be the pitch that you might hear out of Harris and Biden. I don't know if you're going to hear that from Trump because, why?
Well, all I would say off of that is watch the housing market, watch the mortgage market, right? If people start to buy houses, that's certainly some economic activity. That would be a new trend that we haven't seen in some while. If we start to see,
I have a dream of buying a house one day.
It'll happen. It'll happen.
Well, if you stop buying new suits, you might
right,
be able
there we go.
to
It all comes full
afford.
circle.
No, but he needs the brownstone for the suits. Guys, it all works together.
Yes.
It does. It does. All right. Great wrap up, you guys, on this Fed day. That's our cross-platform coverage. Radio, TV, YouTube, Bloomberg Originals. We do it all. Those guys continuing certainly on the TV side of things. And David and I are going to continue here on Bloomberg Business Week on Bloomberg Radio. We'll see you again. Same time, same place tomorrow.
And you definitely want to stick around. We have a lot more coverage coming up. Some great guests, including Claudia Sahm, Nicole Webb, as well as former Fed Governor Betsy Duke. This is The Close on Bloomberg.
Welcome back to The Close. I'm Alex Steele.
And I'm Romaine Bostic, parsing all of the market moves from today's big Fed meeting. And it's not quite what you think. At one point on the day, we did see stocks posting a relatively strong rally, a rally that was taking the S&P to fresh record highs, but that did not hold. A big flip-flop as we got closer to those closing bells, as maybe all of the good news was already priced in. A 0.3% drop in the S&P 500. The home builders ETF, the XHB, at one point was at a record high on a 9-day win streak, but that flip-flopped as well as we got closer to the closing bells. And take a look at the 210s curve, Alex, right now. That uninversion that we've been talking about now, right around 8, that's at the highest level we've seen going back to at least 2022.
But so interesting, it's the long end that's leading it and the sell-off in the long end rather than buying in the short end. So that's interesting as well. I wanted to take a look at two movers today that have nothing to do with the Fed. And there's some interesting ones. The first is ResMed, the worst performing stock within the S&P, down by about 5%. Wolfe Research downgrades the stock to underperform. And the rub here is that if Eli Lilly get its GLP-1 drug medication observed for sleep apnea, it would hurt ResMed, which makes sleep apnea equipment, tends to make makes sense. And then one fun stock here, again, nothing to do with the Fed, is Intuitive Machines, up a whopping 40%. It's Lunar is the actual ticker there. It won a NASA contract, and this one could be worth as much as $4.8 billion. That space race not letting up anytime soon. But our top story for the hour is that jumbo rate cut by the Federal Reserve, 50 basis point cut to defend the current economy and protect the labor market. Fed Chair Jay Powell tries to keep flexibility to move as slow or as fast as needed, but markets still pricing in about 70 basis points of cuts over the next two meetings.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. A broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. If the labor market were to slow unexpectedly, then we have the ability to react to that. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%.
Jay Powell there with the explanations for the big move in interest rates downward 50 basis points as the market was hoping for, and they got it. Betsy Duke joining us right now, former Fed governor and former Wells Fargo chair. And the big question I have, Betsy, is not so much about the rate cut itself, but about those explanations that Powell gave during that press conference. Do you think he threaded that needle well enough?
I think he threaded it extremely well. I was expecting 25 basis points. But when you saw the SEP come in with the median dot at 100 basis points of easing between now and the end of the year with only 3 meetings, that would say there had to be a 50 basis point cut at some point, and this was the right meeting to do it. The nervousness I would have had about the 50 basis points is, would the markets take that as the new normal and start expecting a lot of 50 basis point cuts? I think he did a good job of explaining that the economy right now is pretty close to where they want it, and that this is just an attempt to keep it that way. The 50 basis points certainly establishes the new direction, 100 basis points by the end of the year. But then if you look at the projections for next year, there's only another 100 basis points built in there with the normal dispersion in rates as you go further out.
So this gets to that question then. I mean, the markets seem to have gotten what they wanted in the here and now. Going forward, do you think that what the Fed is going to do, or at least what we think they're going to do, is going to be aligned with what the market wants and what the market expects? Or does that not even matter?
Well, it matters, but actually it matters more in the sense that the Fed tries to communicate with the market what it's thinking and what it's doing, rather than reacting to what the market is seeming to push them to do. So if the market gets way out of whack with what the Fed is expecting to do, they will try to pull those expectations back, as I think Chairman Powell did in the press conference today when he emphasized that this 50 basis points would not be normal.
Do you think that the Michelle Bowman dissent was a big deal?
I don't. I looked at that, and I have a lot of sympathy with Mickey. I suspect she was one of the two that were projecting 50 basis points of cutting in the rest of this year. And so, that led her to her dissent. But I don't think it didn't strike me as anything other than that.
I did notice, though, that 10 officials see 100 basis points cuts or more this year, and 9 see 75 basis points of cuts or less. That feels super divided, is it?
Actually, no. I would say that tells you that it's a very close call. So I would have been one of the 25s, but I could have been persuaded to support the 50. If I had been one of the 50s, I probably could have been persuaded to support the 25s based on what the communication was going to be. So I think the 9 and the 10 being so close together actually points to a lot more agreement than dissent. And, the Fed's just lucky that there was an odd number of people in that room today.
I am curious about the debate process that goes in there. And I know he's asked about it, and as always, he dodges the questions. But he did kind of talk about this idea of everybody kind of writing down on a piece of paper. When we talk about this next phase of this easing cycle, and I feel like it's going to be a little bit harder because you're not just dealing with their own economic projections. you're dealing with what's going to be one way or another a new presidential administration. You could be dealing with some fiscal policy issues that could complicate economic conditions. And I do wonder how he has to approach those meetings and the negotiation process going forward.
So the way this process works is you start out with the SEP, the projections that everybody sends in, those arrive before the meeting. And so when they get there, each person gets to see what everyone else projected. So they have that information going in, and that's where everybody has put their opinions on the table. The discussion in the room is really respectful, and for me, there were times when I was persuaded. And in fact, in the last couple of days, I saw the article by Bill Dudley. I saw a quote from Don Cohn, one from John Faust. All of their logic could have persuaded me in a direction different than where I started. So that's kind of the way it goes. As far as the politics, that honestly doesn't come up unless you're facing something like the fiscal cliff that we were facing back when I was there. I think the big question for the Fed and the economy next year is going to be what happens with Trump tax cuts, because if they expire, that all by itself is a big change in fiscal policy.
It does feel like a takeaway, no matter how many cuts everyone was looking at, is that there appears to be a zero tolerance for labor market weakness. Am I reading that correctly? And how different might that look like than another time?
So the way I would look at it, I look at the confidence charts that come at the bottom of all the projections. And the confidence charts showed a remarkable change in confidence. So in the June projections, there was very low level of confidence in the inflation projections with all the risk to the upside. Now there's a fair amount of confidence and the risk broadly balanced. When you look at what the confidence was on unemployment, it had moved from a fair degree of confidence to less confidence, with the risk being on higher unemployment. So it's not a matter of a single indicator moving anything, but more that some of the indicators affect the judgment of different individuals in different ways. And so it's where does everybody's confidence, where is their confidence and where do they see the risks? And so I think it is a very balanced risk committee right now.
Betsy, it's so great. You truly give one of the best analysis post-Fed. We love having you. Thank you, Betsy Duke, former Fed governor and former Wells Fargo chair. That's interesting that it's very much like it's still so close and what's going to move that needle in a very small direction.
Yeah, absolutely. And of course, now we get to have this great debate once again for the November meeting. 25 or 50, Alex? What do you got?
I'm going to go with I have no idea. All right, coming up, we're going to dive deeper into that 50 basis point cut and the potential impact on credit card spending. We're going to break it down with Sara Rathner of Nerdwallet. This is The Close on Bloomberg. The Fed finally beginning its highly anticipated rate-cutting cycle. So what does it mean for the average person? What's my husband going to ask me when I get home? That's the real question. For more, we're joined by Sara Rathner, credit card expert over at Nerdwallet. Hey, Sara, how does this wind up working, right? So they cut 50 basis points. How does the average American feel it? Where and when?
Well, if you have a credit card, you're probably going to start feeling it within the next couple of weeks. Credit card interest rates are going to go down slightly in lockstep with the Fed decision. If you already have a mortgage or an auto loan, no change for you. But if you were thinking of buying a car and financing that purchase or buying a home in the near future, you might see some more favorable rates depending on what you qualify for.
So for the credit card rates, like how high are they now? And then where do they go? Like, is it a 1-for-1 here?
So right now, the average credit card interest rate is about 22.76%. That's data from earlier this year. That's the most recent data we have from the Fed. It is going to go down pretty much in lockstep. The way credit card interest rate works is they take the prime rate and then they tack on a few percentage points on top of that.
Yeah, I'm not counting on that, Sara. You know, somebody who tries to pay his card down every month to avoid those onerous fees. I'm actually looking a little bit beyond that, and I am curious to what we could potentially see on savings rates. I mean, we went through sort of this period where we were getting like basically 0% on a savings account. That finally went up after all these years. Should I start to expect a drop now in those interest rates on my savings and checking account?
Unfortunately, yes, this is not the best news for savers who have been putting money into high yield savings accounts. Those APYs are going to go down a little bit because of this news. I mean, it's still a great way to put your money into a place and have it work hard for you while you have those savings goals over the next couple of years. It's just not going to feel as lucrative as it's felt over the past year or so. That being said, if that's a good place to park your money for the goals that you personally have, then obviously there are lots of great options out there.
Well, let's talk about some of that too, because when rates really were high, a lot of people, including myself, were getting into CDs, things that I hadn't bought in years, locking in basically 6% rates for a short-term period of time. Is there an advantage to maybe trying to lock in something like that now, knowing that rates, at least based on what Jay Powell said today, are going to come down significantly over the next year?
If you have money that you can lock away for the term of the CD, which let's say it's around a year or so, it could even be longer, then locking in those higher rates and putting the money aside for the time being could be a good move for you if you have some short-term savings goals, but you don't need that money right away. But you want to be mindful that if you do need the money in less amount of time than the CD allows, you might end up paying penalties if you withdraw early.
You got 6% on a CD?
Oh, yeah. Better
6%?
believe it. Oh, yeah. You brag about your mortgage rate. I'll brag about my CDs.
Yeah, no, that's fair enough. When we talk about the lower rates than, say, for APR at credit card, does this help people pay off debt? Does it help on that sense or no?
The thing with credit card debt is it is always expensive. That's just the nature of this type of debt. There's no asset to back you up if you stop making payments. So interest rates are high. So even if rates come down 0.5%, if you have a high balance on a credit card, maybe you'll save $50 a year on interest if you're making minimum payments. Point being, this is the moment to check in on your credit card balances and your interest rates, and even check in a few weeks and see if they've gone down, but see how much you owe every month and see if you could make even more of a payment toward those credit cards, as your budget allows, because you are spending so much money on interest, even with the Fed lowering interest rates.
I am curious, Sarah. I mean, obviously you and really the whole team over at Nerdwallet, and obviously us here at Bloomberg, we obsess over this stuff on a day-to-day basis. But we have to sort of be mindful of the fact most Americans never pay attention to this stuff until they have to or they're forced to in some way or another. Do you think that there is maybe a little bit of a more awareness in the environment that we're in today, given the economic ups and downs, given an election cycle, that people are going to be much more in tune to what happened today and what's going to happen over the next few months?
Well, it's certainly a huge news story, and so there are definitely more people paying attention to what's going on. I mean, we found that 61% of Americans are planning on taking some sort of financial action as a result of the rate change, and it could be something as simple as applying for a new credit card or as complicated as buying a house. So Americans are definitely paying attention because the way the financial situation has been for consumers over the last couple of years, with higher prices, with higher interest, or with things just costing more, it has been a really hard time. And so people are paying attention to financial news and they're wondering how it's going to change their individual situations.
All right, Sarah, great conversation. Appreciate you jumping on today for us. Sara Rathner there, credit card expert over at the personal finance site Nerdwallet. I know a lot of people, like I said, we obsess over this stuff, so we're all sort of waiting for how those rates comes down and what we can do, whether it's refinancing or getting a better credit card rate or something.
Well, that's a great point because does this wind up actually spurring more spending? So rates come down, all of a sudden, then everyone's going to want to go into the housing market, and then prices wind up going up. If all of a sudden your credit card debt comes down, you're going to go spend that money on something else, and does that sort of fuel something there? Yeah, that's, of course, the big question, and something we're going to have to take some time to parse. Of course, another big element of this is what's been going on in the labor market. We're going to talk about how it all ties together with Claudia Sahm, chief economist at New Century Advisors, when we come back on Bloomberg.
In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year.
Fed Chair Jay Powell, once again, this time on the labor market. Powell going on to say that we are, quote, pretty close to max employment. Claudia Sahm joining us right now. She's the chief economist at New Century Advisors and a former Fed economist, and of course, the woman behind the Sahm rule. All right, let's talk about employment and max employment. Claudia, are we there or getting there?
U.S. labor market's in a really good place, right? It's been cooling off some, right? And that is not the direction that we need things pointing. We need a very strong labor market, and we have seen the unemployment rate drift up, particularly since early this year. So that's a problem, and we need more of the job gains. The hiring rate has kind of lagged behind right now. So I don't know if I'd call it maximum employment, but I absolutely agree with Powell that we are coming into this in a position of strength. And what the Federal Reserve showed us today is that they are going to defend that strength by cutting interest rates.
Well, that's the needle I want to thread here, because Powell kind of made it clear, or at least tried to make it clear, that this rate cut was more about supporting a relatively strong labor market rather than sort of saving us from economic weakness. Of course, there's been a lot of hay made about the Sahm rule and its recession signal. And you yourself have already said that, look, there are distortions in the labor market with regards to increasing participation that sort of throws that rule off its kilter just a little bit here. Are we still, even if not headed towards a recession, is there still some risk of meaningful economic softness that we should be paying attention to?
There absolutely is risk of softness. Again, the most disconcerting statistic that we have right now on the U.S. labor market is the hiring rate. And it is back to levels of 2014 when the unemployment rate was 6%. So if you're out there trying to find a job, this is not the same labor market as if you have a job. The layoff rate is really low, which is great, but getting the job right now has gotten quite notably more difficult. And if that continues, the unemployment rate will continue to drift up and the payroll gains will falter. So that there absolutely is a risk, and it's better to act now and the Fed do what it can to stabilize labor market, really reinforce we are going to continue this strong recovery. And I think this was absolutely the right move to make. And it was them coming in and, as Powell said today, recalibrating. Just rates were just a little too high for where they were comfortable with what they'd learned about the labor market.
So this might be a silly question, but if I'm a CEO and I just see a 50 basis point cut from the Fed, what do I say to myself? I'm like, oh, we're good. I don't have to lay off Tom. Like, how does that change?
The Fed's actions today, relative to Feds of the past, so relative to Fed history, this was a pretty bold move to step into an easing cycle with a 0.5 percentage point cut. And the message that Powell was conveying, I think, is the appropriate message. Was this is a vote for the soft landing, that no recession, get inflation down. And I would think if you're a business executive, that's exactly what you want to expand and grow your company into. So that's the intent of this, and it's trying to get ahead of problems as opposed to being. In history, the Fed has tended to be more reactive when things start to fall apart in the labor market, and this Powell Fed is trying to get ahead of it.
So kind of prevent the U3 from rising versus sort of waiting for it or wanting it to go lower, like that distinction. It also feels like the Fed has like a zero tolerance for the unemployment rate to drift higher. Is that fair?
Certainly at Jackson Hole, Powell said further cooling is neither welcome nor necessary. That doesn't mean, today's 0.5 percentage point rate cut doesn't mean the next time the unemployment rate, ticks up, that'll be the same outcome. But it does say that the Fed is watching this, and this is, they want to have the labor market, continue to stay in a strong place. Now, we have to remember that it takes time for interest rates to work their way through the economy, and it's a pretty it's tricky to actually even understand after the fact what the effects were. So we should not think of that the cooling we've seen in the labor market, it's not going to be undone by one decision today. It's going to be a process and how the Fed kind of reacts to that information as it comes in. But we did know they're going to make a whole series of cuts. It may not be this big every time, but we're.
Absolutely. Basically pricing one in for November 7th, that meeting, and December 18th. With regards to those lags, those long and variable lags, and how we talk about it here, I mean, there's been a lot of discussion that the Fed was already late to the party. I'm not sure I buy that, but that's what a lot of people have said. Does 50 basis points catch them up, or is this still going to be, for the next 2 or 3 meetings, them playing that catch up?
The Fed is just starting their easing cycle. So and they had left the federal funds rate at an elevated level for some time. It was over a year from when the funds rate hit its peak a little over 5% until today. So there's still the interest rates coming out of the Fed still are restrictive, and it's going to take several meetings of cuts before that's not the case. I wouldn't say this is they're behind and we're going to see these large cuts going forward in rapid succession. That certainly was not what their projections from the Fed officials were telling us. But it does show that this is a Fed that's willing to be flexible and respond to the conditions that come in and as they change. And that, I think really this cycle has been so outside of the history books that to have policymakers that are willing to roll with it and react and recalibrate. That's the best we can really ask for right now.
Yeah, like how many ways can Jay Powell say that they're data dependent? All right, Claudia, thanks a lot. We really appreciate your time today. Claudia Sahm, Chief Economist at New Century Advisors.
You seem like you got a little tired of the question.
He's like, guys, I've been saying it for like 4 years. We're data dependent.
I thought John Farrell's comment coming out of that was great. He basically said this was a press conference that probably should have ended 15 minutes earlier than what it did. Yeah,
we reporters, we like to ask the obvious question like 47 times. All right, let's take a look at how the markets closed the day. Not what you would have expected with a 50 bip cut from the Fed. The S&P ending down 0.3%. You got small caps pretty much flat on the day. The 10-year is selling off, so you have that steepener or disinversion, but from the long end, not the front end. And gold hitting a record and then moving off of that, ending the day down about 0.4%. This is the close on Bloomberg. Well, the Fed cutting rates today for the first time in 4 years. As that happens, one of my questions is, does it actually reignite growth? Does it cause companies to spend more, reinvest? Does it cause people to spend more on their credit card? Well, here with more is Allison Schrager, Bloomberg Opinion Columnist and Senior Fellow at the Manhattan Institute. And Allison, you actually had a piece out on the Bloomberg that talked about how we shouldn't focus on the gap of rich and poor, but focus more broadly that growth is felt.
Yeah, I mean, I think one of the underreported stories is that inequality has been shrinking in the last 5 years, and it actually shrunk a lot since the pandemic. But the news is actually pretty bad because it only really shrank, certainly since the pandemic, because middle and higher earners had big real wage cuts and lower earners had wage gains, which is great. But if most people are worse off, is society better off if we've shrunk inequality but everyone's poorer?
Okay, all right. That is a question for the day and maybe for the year. But it gets to this idea then, was that narrowing or I guess relative narrowing that we saw, can we credit that to inflation?
Yeah, pretty much it's all inflation.
Okay, so we need inflation back is what you're saying.
Well, I mean, well, the thing is, I think we can shrink inequality and have good growth. It just depends on how it happens. It just so happened that after the pandemic, people lower end of the labor market or lower earners, they were in high demand. Remember, everyone was desperate for, especially service workers. Mm-hmm. So they had these big real wage gains in the beginning while everyone else just got hammered by inflation. But I mean, I think if we worry about inequality, don't make inequality our entire focus, but also think about inclusive growth, then maybe we can have the best of both worlds.
What does inclusive growth look like?
Well, it just means that everyone, actually, this happened during the Trump administration, that everyone had real wage gains. That's what you want. You don't want anyone gaining at the cost of anyone else losing. And it is, in economics, we assume that's possible, but it takes more careful policy, and I feel like for the last 20 years, we've just been hearing a lot about inequality, how it's the defining issue of our time. We've got to get it down. And well, we did, but we saw that how you get it down actually matters more than it going down.
But this gets to the point, too, with those wages going up, those wages aren't necessarily going back down. Mm-hmm. And if inflation is lower, significantly lower than, the 9% headline that we were at on the CPI a couple of years ago, I think that would be a net positive, right?
Well, for lower earners, yeah, but the fact that middle earners, and we can feel bad about higher earners too, but we don't have to. Yeah. They did have 4 years of declining living standards, yeah. Mm-hmm. And that's actually pretty bad. And maybe even if inflation is truly behind us, it doesn't take away from the fact that that was real economic pain people experienced.
So then what is the right growth policy? Like, does it come from fiscal? I mean, what's going to be that happy trigger?
I think it does come more from fiscal. It's not going to come from monetary policy. It's definitely not going to come from today. And it's thinking about growing the supply side of the economy, things like better education, making it easier to move to opportunity. Things like that, you can have broad-based inclusive growth.
All right, Allison Schrager, Bloomberg Opinion Columnist and Senior Fellow at the Manhattan Institute, as we continue to take a lot of different angles to the big Fed rate decision earlier today. And those lower interest rates may have some questioning what they can do to keep their portfolio high quality. Nicole Webb joining us right now, Senior Vice President and Financial Advisor at Wealth Enhancement Group. Nicole, we were speaking a little earlier with somebody about credit card rates potentially maybe coming down slightly from where they are. But I want to talk a little bit more high level about how you kind of structure a portfolio, taking into account real estate, taking into account estate planning, taking into account tax policy, and whether 50 basis points today, and I don't know, the other 150 basis points Powell said he might give us over the next year or so, how that actually changes things.
Yeah. You know, I think the conversations that we're having, especially as we set up portfolio construction, both here now after the first rate cut, but certainly leading up to it all summer, is this intersection of policy going forward, which is still a bit unknown, and then policy in terms of Fed action. And so if we think back even 30 days ago, the risk was that growth was going to cool while we had really elevated valuations in the S&P. And now that the Fed gave us what the market was primed for, which was 50 basis points today, and below the surface, what we were able to take away from their meeting was that we are likely on a pretty slow and steady cut pathway from here, which feels pretty good. And so the setup now is, how do we think about if growth stays at its current potential and we continue to have kind of some of this cooling in inflation towards the Fed target of 2%, we remain in a healthy economy, and hopefully we get a bit more confidence back in that people keeping their jobs. We think now, what are the companies that are likely to benefit from that? As you look at an S&P that, yes, trends towards higher valuations across the board now.
I'm curious, on a day like today, do you get a lot of calls from clients, or are they not as tapped into this the way we are? They sort of might find out about this, days or weeks later and then decide, okay, let me call Nicole and ask her what's going on.
Yeah, I think that's a really fair point. So on our side of the business, we've been extending duration over the past few months in preparation for our expected rate cutting, or what we were really thinking more of a rate normalization cycle that would start this fall. And so clients have been privy to our standpoint on that as we headed into the fall of this year. Also, we've made a really strong move towards quality throughout the summer months. Also, kind of that prudent portfolio mandate where we were thoughtfully trimming and picking up breadth and going down the cap weight as we kind of, again, that intersection of expectations around Fed policy. And so I would say I didn't get many phone calls today, mostly because the action was important leading up to and how we're structured now on the backside of this year.
How much money should someone have in cash, or like a money market fund or a high yield savings account at this point?
Yeah. When we think about money market funds, that's really specific to the individual. I know that often sounds like the cop-out answer. But the harsh reality for many is that the Fed funds rate really does control the short end of the curve, which you and I know, to Romaine's point about being super dialed in to this moment in time. And so we've been working really hard with clients to hone in exactly on what they needed in the short term, because we really do favor the intermediate term of the yield curve right now. And so getting as much money to work at that intermediary point, because the long end of the curve has been wrought with action as we headed into today's Fed cut.
So if one were to move their money from their money market fund or high yield savings, it belongs to the bond market in essence? Is that what you're saying?
I mean, generally speaking, if we're thinking about traditionally thinking about what percentage of your money sits in cash and cash equivalents, fixed income being slightly different, because when we think of traditional fixed income, although there's been a lot of T-bill and chill over the last couple of years, we think more in that intermediate term to long-term duration for fixed income. And so we are kind of navigating that closely because on one hand, if you think today, if you take the Fed meeting minutes at its word and you think that today was 50 and a series of 25 to come over the next 12 months, well, one could make a strong argument that you're still getting a great rolling 12-month yield on a money market versus going too far out into the intermediate space. And so I think it's really navigating that on an individualized basis.
Yeah, because it's hard to sort of find the excuse to come out of that. I mean, obviously, if you just look at Bloomberg pricing, you're at 4.5 on a 6-month bill. And of course, money market funds, you can probably even squeeze out maybe a little bit extra out of that here. And then you look at the volatility in markets right now, particularly given that we're in an election cycle and all the other things going on in the world, is not just the actual value that you're going to get, but it's the relative value related to risk.
Yeah, and I think most of our clients in that, high net worth, ultra high net worth space, you think about your public market exposure as, both looking for optimal return and also constraint around volatility. And that's some of where that preference has tended towards in the private markets, where you don't necessarily see the need for constraint around volatility because of the illiquidity component of it. When you think about your public market exposure, whether it be on the fixed income side, which was a wake-up call for many in 2022 who caught themselves offside from a duration standpoint, or on the equity side, this is really where one has to be thinking about exposures, both kind of at that index level and then also at the quality level. And then on the fixed income side, even more specifically, in where am I picking up yield and exposure?
All right, Nicole, got to leave it there. One of the best in the business, Nicole Webb, a financial advisor and senior vice president over at Wealth Enhancement Group.
Well, the U.S. Securities and Exchange Commission is approving rules that will allow thousands of stocks and ETFs on exchanges to be quoted in half-penny increments. Romaine and I caught up with SEC Chair Gary Gensler on the agency's unanimous decision earlier today.
This is a good thing for everyday investors because the narrower what's called the bid-ask spread, that half penny in the future, which is now a minimum of a penny, that's less that you as an investor, everyday investor, have to pay to the market for liquidity to do your transactions. And economists have said this for a long time. We put a restriction into the market in 2005 that you couldn't quote in less than a penny. I think that was outdated. We relaxed that and moved it to a half a penny. Good for investors, good for capital formation in America.
As the SEC, you guys have a tool that helps you see, who's trading the markets. It's called the Consolidated Audit Trail. There's been some pushback on that and some lawsuits that could really put its existence in jeopardy. Do you guys have a backup plan to see kind of how then you have transparency in the markets? How do you see who would be in the market?
Alex, it's really important to the markets that the stock exchanges, the other self-regulatory organizations, and the SEC be able to guard against manipulation in the market and other bad action like jumping ahead or using quotes from folks to spoof the market and so forth. And so for a long time, for decades, we've had certain transparency. This consolidated audit trail would be more efficient. It was put in place starting in 2012, if I recall. And you're right, there's some lawsuits around that. I'm not going to comment on that. We always do things according to the law and how courts interpret it. But the key really is to help the stock exchanges, the self-regulatory organizations, the SEC guard against manipulation, insider trading, and other, bad things in the market, and that boosts trust in the market.
Do you feel, Gary, that investors today are better protected than what they were in the past, particularly given that we're having this conversation on the anniversary of the week of the collapse of Lehman Brothers, AIG, and of course you being brought in back in 2009, a year after all of this, at the CFTC at least, to kind of help clean all this up here? When you look at where we stand right now, how does it compare to then?
But I think a lot's changed since 2008 and 9. Markets are much more electronic. much more algorithmic trading, much more even use of artificial intelligence in the markets. Commission levels have come down. Another thing is the everyday investors, the retail public, is more engaged in the market, more participation in the market. But it doesn't mean that a gold medalist, and I think we are kind of the U.S. capital markets, this $55 trillion stock market is the best in the world. But it doesn't mean you still have to kind of punch and trade, basically train to do better. That's why we shortened the settlement cycle earlier this year. All investors will know this. You sell your stock on a Monday, you get your cash on a Tuesday. You don't have to wait till Wednesday any longer. These reforms that we did today, I think, are consequential reforms to lower the cost of the market.
I am curious about rules going forward, particularly as we move from a market that I think was a little bit more subject to human infallibility. And now we're sort of moving to an era where you mentioned the algorithms. Of course, artificial intelligence is being deployed at a lot of these firms now. And we don't have, not yet, any sort of clear set of rules as to how to manage the risk that bringing more automation into this market brings.
Well, we've been automating for a long time. I mean, I'm told that well over 100 years ago, there were debates on whether to let telephones on the floor of the New York Stock Exchange. So automation is a good thing overall, but you're absolutely right. We have to also make sure that we still protect the investing public. In terms of artificial intelligence, I think it can bring greater access and promote markets, but at the same time, we have to guard against fraud, and fraud is fraud. And whether you're using an algorithm to defraud the market or your human is doing it, it's against the rules. I do think that there's a challenge that the financial crisis of the future might be that we say, oh my gosh, we were all relying on the same model, the same algorithm, the same data. That's a challenge that is on this guy's mind.
All right, and that was part of our conversation with the SEC chairman, Gary Gensler. Of course, he came on to really tout the approval of those rules here that effectively allows those half-penny stock transactions, also lowering brokers' fees, but wide-ranging conversation about crypto and a few other things as well.
Yep, I asked about crypto, right? There were some Republicans that were interested in airdrops and Gary Gensler stance on that. Yeah. Sort of like kick off some crypto trading.
And they're having a big hearing on that next week in the Senate.
He said he got a letter, but he didn't have any stance on it. So there you go.
Didn't have any stance on it. Well, he does have pretty strong opinions. Also said he plans to stick around through the end of his term in 2026, and they said he would even be willing to continue on, depending on, I guess, whether the new administration, whoever that may be, wants to keep him.
Yep. We'll see.
Are you sticking around? Are you sticking around? You're normally not here this late.
I know. I don't know what time it is. It's very confusing. So what do we do now? There's how long until
well, let's just say
end?
it's 5 o'clock somewhere. We are going to push you ahead to some of the big market-moving events, potential market-moving events over the next 24 hours. And we start in the morning with earnings.
Yay.
Who you got?
We got Cracker Barrel. I've never eaten in a Cracker Barrel.
Gosh,
I know,
really?
I know.
How are you an American?
I know. It's terrible. But I hear it's like worth doing, but they've also been really struggling. So that's going to be interesting. And Darden Restaurants also will be a really good read, I think, on the consumer, but also just inflation and what the pricing power is of these guys.
Another read on the consumer and on inflation maybe is in the aftermarket, some more earnings there, including out of FedEx and Lennar, the home builder.
Yep, definitely looking forward to that. Also, any commentary on a 50 basis point rate cut on the Lennar conference call will be quite interesting. Like, is it immediate demand? How did they see it? And what does it do to actual pricing?
And at 7 a.m. Eastern time here in New York, we're going to get a rate decision, but over in England.
BOE. BOE.
Who you got?
Who I got?
25 or 50, Alex?
Well, we had services inflation actually ticking a little bit higher. Yeah. So did they look through that and continue on the cutting mode and sort of look through any inflationary impulse?
And meanwhile, back here in the U.S., we do get some more economic data, those weekly jobless claims numbers, as well as existing home sales. Of course, team surveillance will be all over that in the morning. But join us tomorrow afternoon right here on The Close for all of your markets coverage. In the meantime, stick around. Politics, that's coming up at the top of the hour with Balance of Power right here on Bloomberg.